Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about the collapse of S2 Capital. It's one of the largest failures we've seen in multifamily syndication in recent years. Reports now indicate that investors in the firm's flagship funds are expected to lose about $400 million of equity. That's a staggering number, and it deserves a closer look. Not because it's an isolated story, but because it illustrates what happens when an investment strategy that works brilliantly in one market cycle collides with a completely different economic reality. And let me be clear, I am not here to criticize one company. Scott Everett and the team at S2 Capital built an impressive organization. At one point, they controlled tens of thousands of apartment units across the Sunbelt. They were hardly alone. Throughout the period from 2015 through 2022, hundreds of firms pursued virtually the same strategy. Buy older Class B and Class C apartment communities, renovate the units, increase the rents, refinance, and return capital to investors. Rinse and repeat. For nearly a decade, it seemed almost foolproof. Interest rates kept falling, capital was abundant, and population growth fueled demand across Texas, Arizona, Florida, and the Carolinas. Cap rates continued to compress, and investors rewarded anyone who would promise a few years of rent growth. And then the world changed. Looking back, one of the likely reasons we deliberately stayed away from B-class and C-class value-add market through the period of 2020 through 2022 was that the numbers simply didn't make sense to us. The underwriting assumptions were becoming increasingly aggressive. Purchase prices assumed substantial rent growth almost immediately after acquisition. Exit cap rates often assumed values would remain elevated indefinitely. In many cases, financing relied upon floating rate bridge loans that required everything to go according to plan. Well, that combination made us uncomfortable. By the end of the pandemic, inflation was clearly becoming embedded in the economy. It was clear that central banks would have no choice but to raise rates. And by 2022, I recorded a number of episodes warning that floating rate debt represented one of the greatest risks in commercial real estate. Those warnings weren't based on any special insight. They were simply a logical conclusion based on how the math works. Floating rate debt is wonderful when rates are stable or falling, and it can be devastating when rates rise several hundred basis points in a short period of time. That's exactly what happened. Within less than 2 years, borrowing costs increased dramatically. Debt service on many apartment properties exploded just as owners were attempting to complete renovations and increase rents. And unfortunately, that was not the only problem. At the same time, the Sunbelt experienced one of the largest construction booms in modern history. Hundreds of thousands of new luxury apartments entered the market. Developers began offering reduced deposits, generous leasing incentives, just to achieve their occupancy targets. Older value-add properties suddenly found themselves competing against brand new buildings, offering aggressive concessions. Their business plan assumed rising rents, but instead rents were falling in those older properties. But then operating expenses didn't cooperate either. Insurance costs climbed sharply, property taxes increased, payroll costs increased, maintenance increased. Every major cost category seemed to be moving in the wrong direction simultaneously. And then came the final blow. Cap rates expanded. When interest rates increase, investors demand higher returns. Higher returns translate directly into lower property values, because on a comparative basis, the risk-free rate of return in, say, a T-bill or a treasury bond can comparatively look more attractive. Even if a property's operating income remains unchanged, an increase in cap rates can erase 20 or 30% of its value overnight. Combining declining values with higher borrowing costs and aggressive leverage, equity can disappear quickly. And that's precisely the environment that many sponsors encountered. The S2 story is important because it reminds us that leverage magnifies outcomes in both directions. And during the boom times, that leverage amplifies the returns and makes the sponsors look like geniuses. During the downturn, that same leverage amplifies the losses. The underlying lesson extends far beyond just one company. Real estate cycles rarely fail because of one mistake. They fail because several risks became correlated at exactly the wrong moment. Interest rates increased, construction supply surged, rent growth stalled, operating expenses rose, and then the capital markets froze. None of those developments by themselves would have been fatal. Together, they created conditions that few value-add business plans were designed to survive. Now, one of the most valuable disciplines in investing is having the courage to pass on deals that everyone else is excited about. And during the pandemic buying frenzy, many investors questioned why we were not pursuing more Class B acquisitions. The answer was simple. We couldn't make the numbers work without assuming an unusually optimistic future. When your underwriting depends on everything going right, you're probably paying too much. Now, to be clear, I am not tied into what happened specifically at S2 Capital. A few people I've spoken with have been critical that the sponsor collected fees when they recapitalized projects into a REIT. Now, I'm sure this was done correctly and in compliance with securities regulations, but some investors have objected to the notion of the developer collecting significant fees on what amounts to a rescue that, by the way, ultimately failed. Successful investing is not about participating in every opportunity. It's about surviving long enough to participate in the next cycle. And there will undoubtedly be outstanding opportunities to acquire apartment properties over the next few years. Some will be distressed sales, recapitalizations, loan restructurings. They're already creating attractive entry points for well-capitalized investors. Ironically, many of tomorrow's best investments may come from yesterday's most aggressive acquisitions. Every real estate cycle teaches the same lesson in a different way. Markets reward discipline over excitement. Conservative underwriting rarely makes headlines during the boom years, but it often preserves capital when conditions change. The collapse of S2 Capital isn't the story of just one sponsor. It's the story of an entire investment philosophy meeting a macroeconomic environment it had never been forced to navigate before. As investors, our objective isn't to predict every twist and turn in the market. It's to structure our investments so that when the unexpected happens, as it eventually does, we're still standing. And that's the difference between surviving a cycle and becoming one of the casualties. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.